Hello and a very warm welcome to a brand new episode of ET Mutual Funds Talk, your own destination to get investing ideas by experts. Today we'll be talking about RBI hikes repo rate by 35 basis points. What should be your mutual fund strategy? And today we have with us a very special guest, Mr. Madhu, editor, Mutual Funds, Economic Times Digital. Welcome, Madhu, to the show. This is the fifth rate hike by the central bank in this financial year. What is your take on it?
See, the first thing is whenever there is a rate hike by RBI, most people know that interest rates have gone up. So they know that, their home loan rates will go. If they are buying a car, they have to pay more interest. All these things people know. But what they don't understand is whenever the rate hike happens, it has an impact on the economy. It has an impact on what kind of increment you will get or what will happen to your investments. So we will discuss here mostly to do with what will happen to your investments. Before that, first we will see why RBI is raising rates. So whenever the economy is on an overdrive, for instance, a lot of money is created, then the inflation goes up. When the inflation goes up, the central banks, their tool is to really signal to the system, banking system, saying that the rates are going up. So banks will become very careful of lending. So the interest rates goes up, so people don't borrow much. So then the growth will also come down. So eventually what happens is the money doesn't really happen. So inflation, they control. If you actually look at it the major mandate of all the central banks, including RBI, is to control the inflation. So that is why the policy rates are hiked again and again.
So how will this rate hike impact the debt mutual funds?
A rate hike is always bad news for mutual funds, whether it is debt mutual funds or equity mutual funds. Debt mutual funds in the sense that
a rate hike is always a negative news for long-term debt funds and gilt funds also.
Yeah, it's not really just for long-term, even for short-term debt funds, it's always a bad news. It's mainly because whenever the rate goes up, the price of debt instruments where the mutual fund invests, that comes down. So that is why the NAVs will come down. So that is why it's a bad news for all debt mutual fund investors.
So according to you, which industry will benefit out of this rate hike?
So investments, if you look at it if you look at the debt mutual funds, you have to actually look at what is happening across the debt mutual fund space. So if you look at it most of the debt mutual funds, short-term debt mutual funds has given slightly better returns, still not very good returns. It's 3% to 4.5%, which is actually what you really get at savings bank account. But if you look at the long-term debt funds, they have given 1% returns. So it's actually very bad year for debt mutual fund investors the whole year.
So what do you think will be the psychology of an investor? After this fifth rate hike by RBI, where do you think investors will invest now, FD or mutual fund?
People who don't want to take any risk, they will actually prefer FDs because when you can earn slightly higher returns without taking any risk. That's always better, right? In debt mutual funds, whatever, irrespective of whatever, whether it's a liquid fund or whether it's a dynamic bond fund or whatever you take your choice, there is always an element of risk. When it comes to an FD, it's almost as good as guaranteed. So people would prefer that. But why a lot of savvy investors invest in debt mutual funds is mainly because one, it's better post-tax returns. if you hold your debt mutual fund for like 3 years, you pay 20% tax with indexation benefit. Whereas in a FD, you have to pay at the rate of your tax rate. For instance, like 30% if your tax rate, then you have to pay 30%. So that is why, like, smart people will still do debt mutual funds, thinking that, they will get a better post-tax return.
And which equity mutual fund do you think will attract now? Large cap, mid cap, or small cap?
We always tell our readers to always keep your goals, your horizon, and your profile, risk profile. So for people who are really like investing at this point of time, if their profile is like conservative, that is like they want to create wealth without taking too much risk, they should always stick to aggressive hybrid fund or large cap mutual funds. People who really have higher risk appetite, they can go for mid cap or small cap, but depending on their profile. For instance, like you won't be comfortable with small cap fund, then you shouldn't.
Yes.
Though you would hear saying that, the interest rates hike have happened, now it is like rates are going to stabilize, so long-term debt funds are good, or this particular equity fund is good. No, you don't jump into that just because, the circumstances have changed. You always keep your profile, your risk, your goal, your investment horizon in mind.
So what is the outlook for the future course of action by the RBI?
RBI is still not very comfortable with the kind of inflation we are dealing with, because RBI's mandate, it's like a 4% is the inflation band. So you can really add 2% more to that. So 6% RBI will be comfortable. But even now, the projected rate is 6.7%. So they're not comfortable. But most of the money market experts believe that RBI is unlikely to go for a steeper hike. Even this one, if you look at it, it's not a 50 basis point, it's 35. It's all that earlier 50 basis point, everybody thought that it's going to be bigger, steeper hike. If you look at the developed countries, even now the hikes, everybody is expecting a steeper hike. That won't happen here.
So what will be a consequence of that?
No, now most probably RBI is unlikely to hike rates. This year it's all done. So next year, probably the first quarter, we will see a small hike. Then RBI might pause and look what is the impact of all these hikes happen, whether it is going to have an impact. So now we really think that, whatever hikes are happening are going to be very measured and result oriented. RBI will look at the data, only then RBI will decide whether it is going to hike the rates.
Right.
So at the point, my only request to all the investors is there are lots of debt mutual funds. So don't look at the returns and then decide that, okay, this scheme is giving me better returns, so I'm not getting. So debt mutual fund is slightly more complex than even equity mutual funds, because debt mutual funds, depending on your risk profile and the time period in which you want to invest, their names change. So people don't know, for instance, what is a liquid fund, how many years I can invest in that, or is it target maturity plan, how does it work? So my request to them is don't get swayed by the returns and all these names. Look at your time frame. Look at the kind of risk you are taking. For instance, if you're going to park money for say a few weeks or a month, then you should look at only liquid funds. At that point of time, you shouldn't look at dynamic bond fund thinking that you can earn better returns there. That shouldn't be the thing. So it's always what you are looking for. If you're investing for a few months, you can go for an ultra short-term fund. If you're investing for a year, probably money market fund or a low duration fund, and then you can look at short-term funds. Then you can look at like banking and PSU fund, or you can look at credit risk. Like, now everybody looks at credit risk because that is the only debt mutual fund category which is giving double-digit return. But if you look inside, you will figure out that one scheme in that category has given almost 145% returns. And people will be like, if they don't look at it, they are like, oh God, this category has given 14% return, so I should put the money. But if you look at it, like, it's skewed because one particular scheme got some money, which is a default, it came to. So their return has gone up, so the average return has gone up. So it's not that credit risk has given like phenomenal returns at that point of time. No, even credit risk is impacted. So my thing is that always look at what do you want, what is your investment profile, what is your risk profile, how much time you have in hand, take your call accordingly.
Great. All right. Thank you so much for taking out time for us. Well, that's all for now, but do stay logged on to ET Markets and ET Mutual Funds for more investment ideas.